Investments in securities are subject to market risks. Read all related documents carefully before investing.
Welcome to the Weekend Investing Daily Byte Space Shooting episode on 4th of May. And the market continues to rally on despite the Fed hike last night. And the US market actually is not looking so pretty with the banking sector bleeding like anything. The regional banks are going down on a daily basis and causing a concern about the entire structure of the regional banking there. Nevertheless, India seems to be unperturbed so far. Nifty climbing another wall of worry after the Fed hike and closing at 18,255. So now a stone's throw from the all-time high, and the inverse head and shoulder pattern that we were talking about a few days ago has done well, and it should ideally retest at least the previous high, if not break it immediately. So this is the context in today's situation. Three heavyweights pushed the market up: State Bank of India, HDFC Twins, Bajaj Twins, SBI Life, BPCL, Asian Paints, Adani Ports, Adani Enterprise, Levers, and some kick from TCS, Titan, Sun Pharma, Bharti Airtel also. Some very minor losses on a few stocks. I would think that this is more of profit taking, and one can ignore those minor losses. But I think the biggest news of the day was the from Adani and crashing through. The EBITDA is like many times fold what was last year's, and it will be very interesting now to see how the market takes cognizance of these results, because the results are extremely good, and we have the Hindenburg overhang on this stock. So this is something that one should look out for. Overall, in terms of sector, again taking the lead in the last few sessions because of go air issues. Some of the lending PSU banks were beaten down. They have recovered a bit. Metals are up 1.2%, so very good gain in metals. Infra, energy, commodities also up nearly 0.5%, along with pharma and IT. And as you can see, public sector enterprise that has been running very hard. Autos, real estate, and FMCG were the ones which were a bit muted. So overall, for the past 1 week, PSU banks, public sector enterprise, and energy and commodity stocks have done the best. Over the past 1 month, real estate and PSU banks have been the leader. For the past 3 months, you can say real estate, public sector enterprise, and PSU banks have held the leadership. So all is looking quite all right now. In fact, a lot of folks in the market are already feeling a little left out because the market has suddenly, gained more than 1,000 points almost, and the Nifty midcap also has jumped from 29,200 to 32,300, so more than 10% here. Very near now all-time highs again, and small cap index is very near its trend line resistance, where I'm expecting some consolidation, but who knows, it may just slice through, like a hot knife in butter. So let's see how this plays on, but very good price action from 8,500 to 9,500 on small caps also. Nifty Bank, of course, is the strongest of the lot, with HDFC Bank kicking in today at 43685, very near now at an all-time high, and on a closing basis, it is less than percent or two away from the all-time high. So this is all looking quite good. US dollar index dramatically is consolidating very near this 101 breakdown mark, below which I expect this to drop dramatically, even below 90 levels. So once this downwards journey starts, which in my mind I'm biased, but in my mind I'm pretty sure that we are going down on this, and unless we break 106, which will alter my assessment on this, I think we are going severely down on this. And once this down journey starts, that should give a good fillip to funds flowing through emerging markets, funds flowing to precious metals. And what a glorious day yesterday was in terms of gold INR. And what we have seen after Fed's hike, gold has made a new all-time high in Indian rupees. On a calculated basis, it went up to as much as 6,300 uh, per gram, but it has today hovered around 61, 64. So very, very good gains here. It was just 4,900 few months back. And you can see the kind of growth it has had in the last 6 7 years, beating most of the index performance, etc. uh, Gradually people are warming up to the idea that gold should be part of the portfolio, but still a lot of folks are brainwashed by the equity gurus of the past, who have said that gold doesn't produce anything, so it is just a pet rock, it is a useless piece of stone. But the central banks don't think so. Central banks are continuously accumulating this, and the people who control the money and who create the money, if they are accumulating gold, you can yourself assess what is the value of gold. So I won't say more than that. So we are at this juncture now where Nifty is very near all-time highs again. Bank Nifty is very near all-time highs. Small caps and mid caps are doing well. Should we be optimistic or stay a bit cautious here? So this is sort of a fact check in terms of where we are in terms of global headwinds or local tailwinds. So I tweeted that Nifty not yet jolted, but the more you read into what the Fed has said, more is the confirmation that the headwinds are far from over. So the Fed has said that we are not going to hike immediately, but we are going to watch the data and then see if we need to hike more later in the year. Now, what has happened is that inflation has come down a bit, and that is because of the base effect from last year. So, inflation, if it was 10% and now it is 6%, does not mean that prices have come back from where they started. It means that what had gone from 100 to 110 is now at 117. So, I mean, a lot of times these figures tend to confuse people. Even the PMI, services index or PMI manufacturing index, people see it as, if it has come off, then the, it's come back to where it started from. But inflation is cumulative. So what was 100 rupees 2 years back? Last year inflation was 10%, so it became 110, and this year it is 7%, so it is now 117. So we are still 17% above where we were 2 years back. So the continuous bleeding of your purchasing power is happening even when inflation is at 6%, even when inflation is at 10%. It is just a matter of a degree of how much poorer you are every year. But you are getting poorer every year, that is for sure. So now what is happening is that with inflation coming a bit off, this hike in Fed rate hike has been stopped for now. Also because at 5.25%, where the Fed rate is, things are beginning to come apart. So a lot of banks had accumulated assets at 0% or near 0%. And now at 5.25%, they are having to market that asset base. So as interest rates are rising, that asset value is coming down. Mainly the U.S. Treasury, uh, and banks are sitting on those losses. So they don't have to enough to give confidence to their borrowers that we'll be able to make up when you come looking for the depositors. I'm sorry, from the depositors, they are not able to give them the confidence. So there is continuously a bleeding of the deposits from these regional banks, which are slightly smaller banks, uh, 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 versus the big large banks, like JP Morgan, etc. So, and these smaller banks which are breaking down, three of them having gotten smashed out, are of the size of nearly HDFC Bank. So these are important, significant assets, banking assets. that are being liquidated like nobody's business. And I'll show you one chart which is more telling. So what has happened on Fed hike last night? US equities went down. So US market did not cheer the fact that the Fed has stopped raising now. Gold is up. So gold went up from $2,020 to 2,080 when it was announced, and then of course later on it came down to 2,040, 50. So whenever gold in dollar terms is going up very rapidly, that is always a time of high risk of uncertainty. So equities in that environment are not the best sort of asset classes, although your exposure to equity should remain. So asset allocation becomes very very important, and following the price uh, is the mantra then. So this Crescat capital sourced graph is showing you what is the bank failures in terms of number of banks failures. So the number of bank failures that happened in 2008-9 went to over 150 banks failed, over this entire period. And right now it is only just few handful, not even 10. And already the assets of these bank failures is much much higher than the 2008 crisis. So the Fed has really put in a lot of backstop to these depositors. $17 trillion worth of depositors have been told that don't worry, your deposits are insured. So essentially, what the US is doing is it is giving a blanket cover to all banks, all depositors, and have told all banks that you can take par value from us even if your asset has depleted. So, in some sense, we are headed towards renewed inflation, in my view, where uh, after a certain time, let's say a few months down the road, inflation will come back in waves. That has happened in 1970s also, because people are now cautious. They are now removing deposits, because see, what has happened is that the money market funds in the US are yielding 5%, 5.2%, and banks are giving them 0.5%. So imagine that your FD is making 0.5% in your savings bank, whereas you can take a GSEC or some other bond like that, which will yield you, 5-6%. Where will you keep your money? Of course, very urgent emergency money you may keep in the bank, but other than that, you will try to, move your funds. So that is what is happening in the US also. Nobody wants to keep their money at 0.5% in a regional bank, and everybody wants to move their funds to a higher yielding uh, uh, instrument. So the insights from all these you know mm, events and the way it is going is that nothing has been fixed in the world. I mean, I'm just giving you my view. I could be totally wrong on this, but this is my view, that since 2008, since the crisis happened, we have been kicking the can down the road. Anytime there is a crisis happens, the money taps are opened up, and that crisis is shoved under the carpet for some time. So that is continuously happening. And the problem is that now at 5% or so, even if we remain at 5% for the next 1 year, there will be a lot of institutions, there will be a lot of holders of various debt instruments, treasuries, etc., that will continue to fail and continue to collapse, because that kind of a debt level that they have raised, 30 something trillion-dollar debt is there. Everybody's having to pay 5+% of interest on it. Where do you get that income from to pay that 5%? Either you're growing very rapidly, your GDP growth is 1%. So you have no growth, but you have this increasing amount of interest to pay. So after some time, each vulnerable level of person or institution or corporate will continue to collapse, because this is a problem that cannot be solved like this. It will require a complete clean out of all the weak hands in the system, and it takes years and decades for that to happen in an inflationary environment. So the ideal way is that inflation continues to run hard, and you allow interest rates not to go up. So you allow inflation to run hard so that your debt uh, gets inflated away. So in 10 years' time, the value of $1 of a debt which exists today will be very less 10 years later, and hence you will be able to pay it off over that time. So essentially, if we allow that, central bankers allow that, decade to happen, that let inflation run hard to some extent, not go hyperbole, but to some extent. But that is also making people poorer, so the working class and the people who don't have it will find it very difficult, and there will be civil rights there. So Fed is in a bind. There is really no solution to this, except maybe some war or some restructuring or some huge kind of collapse. So from a very big macro perspective, very large long term view, we are in a very very bad situation. um, that is my view. This can happen for decades together. That is also possible. We can keep kicking the can down the road till some time, some breakdown happens. Um, Defaults, banking defaults are a classic sign that things are going wrong, and until those stop at some point, you will always be vulnerable that overnight anything can happen. A big large bank can just announce at 11 p.m. Indian time that we are going belly up. So the only way, in my view, is that you must have diversification across asset classes, whether it is real estate, whether it is gold, whether it is anything else but equity. So equity has a role in your portfolio, but so has other things. We have equity products, so people will question me, why are you bashing equity? I'm not bashing equity. I'm saying have allocation to equity, but don't have entire allocation to equity. I mean, that is stupidity in my view. So you could use the 100 minus age. If you're 30 years old, maybe 70% equity. If you're 50-year-old, maybe 50% equity or even less. For gold, you may have half your age as net worth. So if I'm 50-year-old, maybe 25% can be in gold. Uh, and we can do an annual rebalance. Some one of those asset classes goes up too much, take that money out and deploy elsewhere. So you will need to do this, because just having only equity and sitting on a time bomb of the the way the debt time bomb is sitting, that we have here. If that goes off in the rest of the world, India will not be isolated. India will not be like that we don't care what happens there. It will not be like that. We will get impacted. So be prudent and diversify and do asset allocation, but continue your allocation to equity, because we don't know how long this takes. This story can play on for the next 20 years. So be optimistically cautious, play your bets, but have a diversification and your risk management in place. Thank you so much. See you in the next one. Bye.